Welcome back to the Wall Street Podcast. Today, we're diving into key financial and economic signals from the Wall Street Journal Weekend Edition. That's August 2nd and 3rd, 2025. Our aim is to really distill the critical insights, giving you a sharp overview of market movers and corporate strategy.
Exactly. We'll look at the U.S. Labor Department's latest jobs numbers, check in on some major corporate results, and then touch on some broader strategic shifts happening right now.
Let's start with that July jobs report. It came out Friday, August 1st from the Labor Department. The headline number was an addition of 73,000 jobs, seasonally adjusted. That was below expectations.
And maybe more importantly, the revisions for May and June were substantial. They cut job growth by a combined 258,000.
Wow, 258,000 combined. That's quite a downward adjustment.
It is, and it points pretty clearly towards a slowing U.S. economy.
So what does this mean for policy? The Fed, for instance.
Well, this definitely eases the path for the Federal Reserve, makes an interest rate cut at their September meeting seem quite a bit more likely.
Right. There's also that news about President Trump directing his team to fire the top official at the BLS, claiming manipulation.
Yes, that happened on Friday. It's certainly raised some eyebrows among economists, concerns about the independence of that data. We're just reporting what the journal noted there.
Okay. Let's shift gears to corporate performance.
Yeah.
Nintendo seems to be doing well.
Very well. First quarter net profit jumped 19%, mostly driven by the new Switch 2 console.
How many units did they say?
Over 6 million sold globally since it launched back on June 5th. Shows there's still strong demand for dedicated gaming hardware.
But not everyone had good news. Universal Music.
No, their shares slipped. Second quarter earnings and, crucially, free cash flow both missed expectations. That free cash flow miss is often a flag for investors.
And Etsy is changing things up.
Yeah, they're seeing fewer buyers, consumers being more cautious, so they're moving their marketing money away from TV ads.
Towards what?
More towards digital, things like search, paid social media, influencer marketing,
Right.
trying to be more targeted.
Okay. Kimberly-Clark, mixed bag there.
Sort of. Their second quarter adjusted profit actually beat estimates, which is good. But overall sales were down.
Why was that?
Mainly due to selling off parts of the business, exiting certain areas, so divestitures, basically.
Got it. And briefly, Figma's IPO. Something about money left on the table.
That's right, an estimated $3 billion. Apparently, Figma executives decided to cap the IPO price.
Why?
Because the big institutional investors, the large funds, were balking at paying much more than the target range they'd set.
Interesting dynamic. All right, let's look at strategic insights. Chevron and Hess.
Yes, big news there. Chevron won its arbitration dispute with Exxon over the Hess acquisition. That's the $53 billion deal.
And that includes the stake in Guyana, right?
Exactly, a 30% stake in that huge project.
Yeah.
This resolution finally came through almost 2 years after the deal was announced. It really locks in Chevron's long-term reserves and future profit potential.
Meanwhile, in tech, the AI arms race is just heating up intensely.
Oh, absolutely. You've got Google, Microsoft, Amazon, Meta. They're set to spend almost $400 billion this year, combined.
$400 billion on what, mostly?
Mostly capital expenditures for AI infrastructure, servers, data centers, chips. It's massive investment.
Is it paying off yet?
For some, yes. Meta, for example, reported higher ad prices and more app usage, and they attributed that directly to their AI improvements.
But not everyone is spending at that level.
No. Apple, interestingly, spends just a fraction of that on CapEx generally, and is seen by many as, well, lagging a bit in the AI race compared to the others.
And looking even further ahead, quantum computing.
Still developing, but IBM has a target. They want a fault-tolerant quantum machine operational by 2029. The potential there is huge: faster internet, new medicines, material science.
Okay, let's move to our commentary modules. 3 key questions. First, what's the single biggest takeaway from that jobs report for monetary policy?
Well, I'd say it's the combination of the low July number, just 73,000, plus those really large downward revisions for May and June, the 258,000 cut. It sends a pretty unambiguous signal that the U.S. economy is weakening.
And that means?
It significantly boosts the odds of the Fed cutting rates in September. They'll likely want to provide some support if the slowdown looks sustained.
Second question, how are the big tech players positioning themselves in AI? And what are the financial implications?
They're positioning themselves by spending enormous sums of money. As we said, close to $400 billion this year, just among the top few: Google, Microsoft, Amazon, Meta. This creates a huge need for financing, obviously.
But it's also driving profits.
Yes, that's the flip side. It's boosting their core businesses. Think higher ad prices for Meta and Google, more efficient cloud services for Microsoft and Amazon, better app engagement. It's expensive, but it seems to be integrating directly into profitability now.
All right, final question. The Chevron-Exxon dispute resolution over Hess. What does that signal for the energy sector?
It signals that major strategic deals, even complex ones with disputes, can get done. Chevron securing that Hess acquisition, especially the Guyana stake, really solidifies its long-term reserve base against competitors like Exxon.
So it strengthens Chevron's position.
Definitely. And it might suggest, more broadly, a tougher, more determined approach in corporate strategy within the energy sector. It could potentially help Chevron close some of that valuation gap that's existed with Exxon.
Okay, that brings us to the end of this deep dive.
Yes, we've covered quite a bit from this weekend's Wall Street Journal. The labor market's strength is clearly being reassessed, and this AI investment race is just transforming capital allocation in tech.
Definitely things to watch.
Yeah.
You might consider how these huge concentrated capital flows into areas like AI could reshape sector valuations and the competitive playing field in the months and quarters ahead.